Okay, hi everyone, I'm James Hart and welcome to this Orbex educational session where we're going to be looking at two of the most popular technical Forex indicators. And in these sessions so far, we've looked at indicators such as the RSI, stochastics and MACD that are focused really on indicators which appear in the sub-panel below our price charts. But today, with moving averages and Bollinger Bands, we're going to be looking at indicators which are plotted onto the price charts themselves. So, before we get going then, as ever, I just want to reiterate that if you have any questions during the session, please just type them in the chat function and I'll try and stop periodically as we go along, and I'll also leave some time at the end for any questions also. Okay, so kicking off first of all then with moving averages. What are moving averages? So essentially, moving averages are giving us a visual representation of the average price as defined over a certain look-back period. So if our moving average is set to 10 and we're on the daily charts, then this is giving us the average price over the last 10 days. Similarly, if we're on the hourly charts and we have a 10-period moving average, then this is giving us the average price over the last 10 hours. Now, the reason why this is referred to as a moving average is because of the way the indicator is calculated. So with each new period that unfolds, the look-back period moves up to cover the latest period of data and removes the oldest period of data from the calculation. So you can see here we have an example then of a moving average, and this is a default 14-period moving average displayed on the daily charts. So this is giving us the average price over roughly 2 weeks worth of trading. Now, one very important thing to point out early on that quite a few of you might be familiar with is the fact that there are a few different types of moving average. In fact, there's actually quite a range of different types of moving average, but the ones used most commonly and the ones that you're most likely to see referenced, indeed the ones that we're going to focus on in today's session, are the following. So we first of all have a simple moving average. So that's the moving average that we just saw in the example, and that is simply measuring the average price over a given period without any extra filtering. We then have the exponential moving average. Now this moving average does the same thing, but its calculation gives more weight to recent prices over older prices. We then have the triangular moving average. So whereas the exponential moving average places more weight on the most recent data, the triangular moving average places more weight on the middle period of the data. So as I say, there are a whole bunch of moving averages that have slightly different calculations, and you can find traders and systems using them all. So definitely worthwhile playing around with the different types of moving averages to find the ones that you like. But as I say, those three are certainly the most common. So moving on to how we trade moving averages then, okay? So the moving averages, traders tend to use them in two ways. Now, one is for moving averages to act as a guide to the direction and the state of the market, and then the second is to explicitly use them for trading opportunities, so to actually use them for entry points to the market. So in terms of using moving averages as a guide, essentially what traders will do is reference a particular moving average whereby if price is trading below its average, then the market is seen as being bearish and trending lower. And if the market is trading above its average, price is seen as bullish and trending higher. So the actual moving average becomes a sort of bull-bear line in the sand, if you will, a price pivot point. Now, you will often hear traders using just a single moving average as a reference point, as we discussed, e.g. price is below its 200-day moving average, Other times you will hear traders referencing a crossing of 2 or perhaps even 3 moving averages as indicating a trend. So in these situations, the crossing of a shorter term, faster moving average through a longer term, slower moving average indicates the direction of the market. So what are some of these moving average crossovers that you might see? Now obviously there are hundreds of different combinations out there, and again I advise you to play around with the moving averages yourselves and find settings that you like and that you can get good signals from. But to get you started, here are some of the common ones that you'll come across. So we have the 9 and 21 day moving average crossover, the 55 and 100 day moving average crossover, the 50 and 200 day moving average crossover, and then the 100 and 200 moving average crossover. So these are the most common crossovers which you'll likely come across in the charts that you see and use. So let's take a look at some of these then as examples on the chart. So here you can see we have the 9 and 21 day moving average crossover. So the orange moving average is giving us the 9 period, and the yellow moving average is giving us the 21. So you can see this is a fairly short-term crossover. We've got roughly half a trading month crossing through a full trading month, and you can see how the moving averages track price quite closely and are fairly sensitive to price swings. Now you'll also notice that we have quite a high number of actual crossovers. So where traders are using crossovers to generate an entry signal, you can see that we actually have quite a few entry points to the market generated by these crossovers. So it does quite well in picking out nice expansion moves in the market. You can see that each time we get an aggressive bullish move, the crossovers tend to pick out these moves quite well. And even within the lesser directional periods, so where we get these range-bound periods, you can see that the crossovers, because of how well they track price, are still able to generate actionable signals. So again, this is the 9 and 21 period crossover. So on this chart we have longer term crossovers. We've got the 55 and 100 day moving averages. And again, this is obviously a much longer term crossover. And looking at the moving averages themselves, you can see they're far less sensitive to swings in price, and they're generating far fewer crossovers. Okay, so unlike the shorter term moving averages, these moving averages aren't tracking price as closely, and they aren't generating as many crossovers. However, the caveat to this is that the crossovers that do work tend to capture much larger moves in price. So you can see that although there are fewer actual crossovers, the crossovers tend to capture bigger moves in price. Here we have the classic 50 and 200 day moving average crossover, and this is one that you'll come across a lot, as a lot of traders and analysts reference this as it's used to denote the direction of the trend. So you might often hear a bullish crossover in these moving averages referred to as a golden cross, and then a bearish crossover referred to as a death cross. Again, you'll note that these moving averages, just as we saw with the 55 and 100, are far less sensitive to price and generate far fewer crossovers. But again, the crossovers tend to last for a much longer period of time and typically capture much larger moves in price. And then finally, we have an even longer term set of moving average crossovers. We have the 100 and the 200. And as you would expect, these are even less sensitive price, again and again have fewer crossovers, but capture bigger moves in price. So just good to show you what those different moving average crossovers look like for those of you who aren't typically familiar with moving average crossovers. And again, just to give you an idea of how the different lengths of moving average track the swings in price and the volume, frequency of crossovers that you can expect dependent on the length of moving averages you're using. So going back to how we use these moving averages then, well, if we're looking at this example here, typically what we will find is that traders will enter the market as the moving averages cross over. So you can see here initially that we have a bearish crossover where the 100-day moving average moves below its 200-day moving average. So this is used to signal a bearish entry point to the market. So traders would look to sell short as the 100-day moving average crosses below the 200-day moving average. Similarly, over here you can see that where the 100-day moving average crosses above the 200-day moving average, this will be used as a bullish signal. So traders will be using this crossover to enter the market long. So these trades that are entered when we use the moving averages, we can use the moving averages as a guide. So we can either expect that the market is going to continue to trade lower because we've identified this bearish crossover, and then we don't simply have to enter at the point that the crossover has occurred. We could then wait to use whatever technical setup it is which we typically rely on. So for example, let's say you're a trader that uses Fibonacci retracements. Well, once you've seen price break lower and that moving average has crossed below, and you know that we're expecting a bearish market, you could then wait for retracements into key Fibonacci levels before setting shorts. Similarly, if you're a breakout trader, once you've identified that bearish crossover and you know that you're looking for bearish opportunities in the market, then you could look for breakdowns below key support levels to set shorts. So the key thing here is that you can either use the moving average crossovers explicitly to enter the market as the crossover occurs, so simply selling on the bearish candle that forms on the MA crossover, or buying on the bullish candle that forms on the MA crossover, or you can simply look to use the crossovers as a guide and then use your own entry points relevant to the specific setups that you typically use. So one method that you will also find traders using is where they look to establish a trending market once a crossover has occurred, and then look to enter the market as price retraces to retest one of the trend lines, one of the moving averages rather. So you can see here that where this moving average has crossed below the 200-day moving average, and we know that we're anticipating a bearish trend developing, we would then look for periods where price retraces to retest the moving average to set shorts. So a good example here in the euro. So obviously over that huge decline that we had in the euro from summer 2014 to early 2015, you can see that we got a really good moving average crossover entry point to that trade. So this is the 50 and 200-day moving average. So where the 50 crosses below the 200-day moving average, this is referred to as a death cross. So once that moving average crossed over, you can see price started to trend lower. And then what we're looking for in this situation, once the moving averages start to turn down, and once price is starting to sell off, we're simply waiting to identify periods where price trades back up to retest the moving average, which we can then actually use as an entry point. Okay, so you can see I've highlighted here, and you can see that this preceded a really sharp decline in the euro. So this would have been a fantastic entry point using a very simple method. So obviously we've got the 50 and 200-day moving averages. We've identified our bearish crossover. We've identified that price is moving lower within a bearish trend, and then we're simply waiting for periods where price trades back up to retest the moving average, where we actually look to enter the market. So what you will often find is that these averages tend to act as support and resistance in the market, especially during these trending phases where price is away from its moving average for a long time. So you can see over here to the left that price is roughly in a range-bound situation. So although we're grinding slightly higher, there's hardly any momentum or volume in the market, and price is actually chopping around its moving average. So in this instance, the moving average loses some of its impact, some of its relevance in the market. However, once price breaks significantly away from its moving average and spends a long period of time having not tested it, then especially the first one or two touches will generally tend to yield quite a strong reaction, especially on the higher time frames and especially with these longer term moving averages. So this is a really good method which you can look to use if you're looking to trade with the trend. And in fact, a lot of trend traders rely on this type of strategy to help them enter the market once a trend has developed. So this is certainly a method which you can encompass into your trading, whether you're a long-term trader or a short-term trader, because these same methods work on an intraday basis if you're using lower time frames and shorter term moving averages. The same principle applies. We wait to identify a clear trend in the market where price is pulling away from its moving average. We're then looking to identify a retest of the moving average to use as an entry point to the market. Now, aside from just giving us a sort of bull-bear view of the market, so aside from just helping us identify the direction of price, moving averages also give us some clues as to the actual state of the market. So if we take this example, you can see, so this is zooming out on the euro. So we were just looking at the euro over this period here, this huge decline. So this is the 200-day moving average. Now you can see that once price has moved into a significant bearish trend and the moving average is showing a gap between price, so price is pulling away from the moving average, this shows that there is a lot of momentum in the market and the moves that we're seeing are particularly acute. And then directionally you can see the moving average is turned steeply down, so this is indicating a strong bearish trend. However, once we get to this point in the market, you can see that where price has bottomed out here and failed to break back down below that initial low, the moving average itself is giving us information, giving us clues as to what is likely to happen next with price. So you can see that whereas the moving average was turned steeply lower at this stage, the moving average at this point here has now turned roughly flat. Okay, so once price starts to chop around and starts to cross back and forth above and below the moving average, this is a good indicator that price has moved into a range-bound scenario. So having identified price as being in a really clear bearish trend over this period of price action, once we make this initial low and price rebounds and we cross above that moving average, we then know that we need to see at least a break of this initial low to confirm a resumption of the trend. And until that has occurred, we know that we're likely to remain in a range-bound scenario. And indeed, if we look at this level here as being the reaction high, so we have the initial low, we have the rebound and the reaction high. Once price comes lower and starts to trade around its moving average again, then we know that price needs to either break above this high for the moving averages to start to turn higher and signal perhaps the start of a bullish trend, or price needs to come down and break below that initial low with the moving averages starting to turn sharply lower to signal the resumption of the bearish trend. So these are the basic ways then that traders can use moving averages, comparing price to its moving average to indicate direction in the market, referencing the position of two moving averages relative to each other to indicate trend direction, and indeed using the actual crossing of moving averages as an entry point, and finally using a test of the moving averages themselves again to offer an entry point to the market. So the question is, do you want to use moving averages? Should you use them? So we've looked at how you can use them, but now we really need to consider whether or not you should be using them. And the bottom line is that moving averages can catch some fantastic moves in the market. Okay, if you pull up any chart you like, stick on a 50 and 200-day moving average, and you will spot some fantastic trends that the moving averages capture perfectly. The issue, however, is that they also go through some pretty horrendous periods where price is chopping around all over the place and the moving averages are constantly getting caught on the wrong side of the market. So you can see here where price is moving sharply lower as the moving averages is turned sharply down. However, once the moving average starts to flatten out here and price starts to chop around, this is when things can get really tricky for traders using moving averages. And the issue is down to the lag or the delay that is present in the way that moving averages are calculated, because moving averages are measuring past periods of price action. They aren't predicting the future. So while they can certainly capture some great moves in the market, as we've seen in these initial slides, one thing that often happens is that they tend to give back an awful lot on winning trades, on some winning trades, I should say. So if you're trading from moving average crossover to moving average crossover, e.g. if you're looking to sell on a bearish crossover and then not looking to exit the market until you get a bullish crossover and vice versa, then there will be a lot of times where price is moving sharply away from the moving averages and is in really good profit, but then comes all the way back before the moving averages cross again to let you exit the trade. So let's take a look and talk through that a little more clearly. Okay, so here we have a really good example of what I'm talking about. So this chart is showing the 50 and 200-day moving averages. So remember, these moving average crossovers are probably the most famous and widely known ones, and a bullish crossover is referred to as a golden cross, and a bearish crossover is referred to as a death cross. So you can see we have some great examples on this chart. We have an initial death cross here, so we have a bearish crossover. You can see price turns sharply lower. The 50 crosses below the 200-day moving average, so we get short at this point here. Price sells off really strongly. We're up over 1,000 pips roughly by this point at the very low. However, if we're waiting to exit the market on a bullish crossover, you can see that by the time we actually get our bullish crossover, we've given back roughly 40 to 50% of the profits that we'd made on that trade. So whilst we would have been up around 1,000 pips at the height, we probably exited at around 600 pips in profit. So we've given back a really large portion of the trade simply because we're waiting for another crossover to occur. Similarly, over here, you can see we have a similar situation, but this time with bullish crossover. So you can see we get our golden cross where the 50-day moving average crosses above the 200-day moving average. Price explodes to the top side. We're up a good 500 pips or so, 500 or 600 pips at the very high. But then look how far price comes back by the time the moving averages cross over to allow you to exit. So we come back nearly all the way to our entry point. And in fact, depending on where we actually entered on this crossover, you can see this crossover, the candle that we would have entered on, is actually below our entry point. So this is a really great example of where moving average crossovers can tend to fall short in terms of allowing you to capture the full extent of the profits on the trade. And especially in these types of markets where we get these choppy short bursts in price. So where price isn't typically trending and we're just rotating within a range, then we may indeed get some of these great moves in price and we may indeed get entry points to the market, but then where the moving averages let us down is in how we exit the market. So all of the profit is given back simply because the moving averages aren't responding quickly enough to price. So what are our options then? Once we've identified this flaw in moving averages, and it clearly is a flaw, well then what are our options? So either we can look to build some sort of system, some sort of mechanized way out of how we trade these crossovers, such as instead of trading crossover to crossover, we trade on a risk-reward basis. So for example, on each crossover, we might look to risk 1 to 200 pips, and then we'd be looking to bank 3 to 600 pips. So we'd be looking to bank 3 to 1 on each trade. So this can certainly work. As we've identified, in these periods of price where the market is simply range bound and we're getting these bursts in price, but then the market is simply turning back and reversing, a system such as this can work really well to help make sure that we still bank good profits on these trades. Now, alternatively, another option is that we could look to use shorter term moving averages. So shorter term moving averages are more responsive to price, okay? These moving averages won't have the same huge runs that we get in the longer term moving averages, but generally you'll get to bank a bigger percentage of the profit on the trades because you don't end up giving so much back. However, the caveat is that you are subject to a lot more whipsaw and a lot more false signals, as when we looked earlier at the examples of the shorter term crossovers, you can see that the shorter term moving averages tend to give more false signals as they tend to cross at a higher frequency. So with moving averages then, as with all technical indicators, strategies and systems even, it comes down to how well you can make them work for you. There are some really big funds that have built profitable systems out of very simple strategies such as moving average crossovers, and there are a lot of really successful manual traders who use them too. So they're definitely worth taking a look at, and as I say, the key thing comes down to spending some time trying out the different time frames, trying out the different moving average lengths, and playing around with different sorts of trade management systems to see if you can find something that works well for you. Because as I've said many times in these sessions, it really doesn't matter how well someone else is using a specific component or operating a specific strategy if you aren't able to make it work for you, okay? And different traders respond differently to different things, different time frames, different methods, different strategies. So if you're still in the process of figuring out how you want to trade, then I hope that these sessions are giving you some really useful insight and prompting you to do your own research and spend time on the charts testing out these different ideas, because at the end of the day, that is what's really going to make the difference to your trading. So we've looked at moving averages then. Now let's cross over to the second part of the webinar and look at Bollinger Bands, okay? And the reason why we've put these two indicators together in this session is because, as you'll see shortly, for those of you who aren't familiar with Bollinger Bands, moving averages are a core component in the Bollinger Bands indicator. So what are Bollinger Bands? Bollinger Bands are essentially a moving average with some added functionality, okay? So they're sort of like an advanced version of moving averages, where in addition to the moving average, which is typically a 20 period, as defined by John Bollinger, the man who invented the indicator, then we also have an upper and a lower line. So we also have an upper line that runs along the top side of price and a lower line that runs along the bottom side of price. And these are volatility bands. Okay, so these identify standard deviations away from the moving average, giving us an indication of the level of volatility in the market. So this is what Bollinger Bands look like, okay? So this funny indicator which shows these bands wrapped around price and then this line running through the middle of price. So as I say, the line running through the middle of price is typically a 20 period moving average. And then the upper lines indicate two standard deviations above the moving average, where the lower lines then indicate two standard deviations below the moving average, okay? So you can see that the bands aren't always the same size. They aren't always the same width apart, rather, okay? At different points, they're very tight, and then at other points, they're quite wide. So the reason for this is that when the bands contract, as you can see here, this indicates that volatility in the market has reduced. And then where the bands widen, so as we see here, this indicates that volatility in the market has increased. So that's the bottom line to the indicator. It's very simple and straightforward. And again, as with moving averages, it works on all time frames. So here we're looking at a daily chart. This is giving us the 20-day moving average of price with two standard deviations of the 20-day moving average to either side of the market. So that's great. We know what Bollinger Bands are. You now know what they look like, for those of you who didn't. Now we need to think about how we can use them, okay? How we can actually trade them. And Bollinger Bands present some interesting opportunities for trading, because if we think about the information that's being provided to us by the indicator, we have the moving average, which we know can be a decent indication of general direction in the market, but then we also have this information on volatility. So how can we actually use this information, and how can we trade this indicator? So the first and most basic way that we're going to consider, and well done if you've guessed it, this is called the Bollinger Band fade, okay? And you may have come across this before, as I say. Bollinger Bands are a very famous indicator, and essentially the premise behind this method is that as price trades into its volatility bands, so for example, as price reaches the upper volatility band, which is 2 standard deviations above the moving average, price is considered overbought. Okay, at this point, volatility is overstretched in the market and price is considered overbought. Momentum is stretched, and so we can look to sell in this instance, anticipating a reversal in price back to its average. And then similarly, as price trades down to touch the lower volatility band, so as it reaches 2 standard deviations to the downside of its moving average, then at this point we can consider that volatility is stretched to the downside, so bearish momentum is overstretched and price is considered oversold, and then again we can look to buy, targeting a move back up to the moving average. So if we zoom in on the indicator then, and in this slide you can see exactly what I'm talking about. So we've got March to July 2015. So we've got a good 5-month period here. We've got a good 5 or 6 month period, and you can see that I've highlighted several instances where price has traded up, or traded down rather, to test the outer volatility bands of the Bollinger Bands indicator. And you can see that each time we've seen some really good reversals. Now, admittedly, each time they aren't always as specific, so price doesn't always respect the indicator as specifically as it does at some points, but you can see that generally each time the move into the outer volatility bands has yielded a reversal. Okay, so in these instances, all we're looking to do is get involved with a reaction as price moves back inside the volatility bands, targeting a move back to the moving average. Okay, so it's a really simple way of approaching the market. It can be a really fantastic way of catching reversals. So again, we're looking on the daily time frame here. So these moves are probably worth a few hundred pips each and can be a fantastic way to swing trade the markets. Now, in terms of how we actually go about entering these trades, as ever, we have a couple of options. So we could trade this in a fairly aggressive way, whereby we simply look to enter the market as price tests the volatility bands. So getting short as price tests the upper volatility band, or getting long as price tests the lower volatility band. And we could use an ATR based stop, so an average true range based stop, such as the 5 period or the 20-day ATR period. So this gives us the average volatility over the last 5 or 20 days. Another way that many traders use these Bollinger Bands is to use price action confirmation. So instead of simply trading the touch of the line as price tests the volatility bands, we could wait for price action to confirm the trade. So looking here at this first example, you can see that price trades down below the volatility band here. We then have another candle below it. However, at this point here, price closes back inside the Bollinger Band. So this would be our long entry point. Okay, price has broken down below the lower volatility band, traded back inside, and all we're simply doing is waiting for a close back inside the volatility band. So we're looking to identify periods when a candle touches the volatility band or moves beyond the volatility band and then closes back inside it. Okay, so here you can see price has moved below the lower band and then at this point closed back above it. So this would be our long entry point. And then to the top side here you can see price has actually traded up, touched the upper band, has failed to move beyond it, has actually reversed and closed lower. So in this instance, it all happens within one candle. And so this would be our short entry point. So looking to use candle confirmation, as we've discussed in some of the other sessions related to other indicators and other trading strategies, is always a great way to add an extra safety filter to your trading. Now, an alternative way of entering the market using the Bollinger Band fade method is where we can look to drop down onto the lower time frames and again wait for price action confirmation. Now, the reason that I suggest using the lower time frames is that sometimes the reaction on the daily charts will simply negate an entry to the trade. So what we might see happen is a daily candle touch one of the lines and retreat too strongly. So if we look at this example here, so price has obviously gapped down below the Bollinger Band, okay, and we're waiting for price to close back inside the Bollinger Band for us to get long. However, you can see that price rallies really significantly here, and we actually close sort of almost at our target. Okay, so if we're targeting a move back to the moving average, you can see that we've closed within the top third of our target. So obviously to enter the market at this point presents negative risk reward. We have to have our risk all the way down to the bottom of the candle, and our reward is only this small area. So this will happen sometimes. You can see on this chart that there aren't many occasions where this has happened, but this is something that does occur, and it can negatively impact your results if you're looking to trade this type of strategy. So this is why I suggest dropping down onto the lower time frames where we can typically get a tighter entry. However, if we drop down onto the lower time frames, we're going to have to use a little trick, okay? So maybe you aren't familiar with this, maybe some of you are. But again, if we're looking to trade a higher time frame indicator on a lower time frame, then we need to adjust the period of the indicator. So if we're looking to trade this 20 period daily Bollinger Band on the 4-hour chart, then when we drop down onto the 4-hour chart, we have to adjust our indicator, because obviously if we simply have it still set to a 20 period, then that's giving us 24-hour sessions, not 20 daily sessions. So how we do this is we take the number of sessions in a 24-hour period and multiply that by the daily indicator period. So on the 4-hour chart, we can fit 6 4-hour sessions into 24 hours, okay? So to find the 20-day Bollinger Band on the H4 chart, we need to change our indicator settings to 120. So that's 6 times 20. So we've got the number of sessions in a 24-hour period times the period of the indicator on the daily chart. So that gives us a 120 period. So instead of having our Bollinger Band set to 20, they're now set to 120. Okay, so this next chart, this shows us the 4-hour charts, and you can see here that we have the 120 period Bollinger Band on the 4-hour charts. I just want to check quickly, is everyone's audio still coming through okay? If you could just type in the chat function if the sound is still coming through okay. Brilliant, great. Thanks for that. I just got a technical message, so I just wanted to check that everyone could still hear okay. Okay, so I hope you're all following that. So as I say, we start off with our daily period of 20. We times that by the number of sessions that we want in the 24-hour period. So because we're on the 4-hour chart, there are 6 4-hour sessions in a 24-hour period. So we do 6 times 20 gives us 120. And so now we're down onto the 4-hour chart, but the lines that you're seeing on the chart are actually in the exact same position as they would be on the daily chart, okay? So we've dropped down to the 4-hour chart. However, we're not looking at a 20 period Bollinger Band on the 4-hour chart. We're looking at a 120 period Bollinger Band, and that's giving us the exact same Bollinger Bands as we see on the daily chart. And now you can clearly see the advantage to this method, okay? So if I just go back one more time, so this is the chart, this is the area of the chart that we're looking at, okay, where price gapped down below that lower Bollinger Band and then price rallied strongly. And the whole point is that if we're looking to enter long on the candle close, we can't do it at this point because we've simply gone too far into the Bollinger Band. Now, if we drop down to the 4-hour chart instead, you can see that we actually are able to find a much tighter entry to price. So you can see that this 4-hour candle closes here. So the first point at which we're able to enter the market is at a much more advantageous position where compared to the daily candle, okay? So the daily candle close would have been up here, whereas the 4-hour close is just here. So you can see dropping down onto the lower time frame, using that clever little trick of changing the indicator periods can be a really fantastic way to gain a tighter entry point to the market. And again, this can be a really fantastic way of using many indicators. So this applies not just to the Bollinger Bands, but to all technical indicators that you use. If you're looking to trade a higher time frame indicator on the lower time frames, then all you need to do is remember that formula for changing the indicator settings, and then you'll be able to trade the exact same indicators that you have on the higher time frames on the lower time frames. And I know this is especially appealing to a lot of day traders and intraday traders. Now, obviously the period that we just looked at was a fairly range-bound period of price action, okay? So we saw price simply rotating higher and lower within a clear range. Now, one thing that we need to consider here, as the same with oscillators, so the same with RSI and stochastics indicators that signal overbought and oversold momentum in the market, is that looking to fade Bollinger Bands can get a little tricky once the market starts trending and starts to push in one direction. Because the issue is they tend to ride along either the upper or lower band and give us a lot of false entry points. So one of the ways that we can actually moderate this strategy to make it really effective in trending markets and to help us trade with the trend rather than against it is where once we've identified price trending in a direction, we then wait to enter the market only once price has crossed back to the opposing Bollinger Band, okay? So if we're in a bearish trend and price is pushing along that lower Bollinger Band, instead of simply getting taken out of the market over and over again trying to get long, we will wait only to trade once price has crossed back up to the upper Bollinger Band, giving us an opportunity to sell in line with the trend. So let's take a look at an example of that then, and I'll talk this through a little more closely. So you can see here in this example that we have the euro dollar again looking at that huge decline from summer 2014. You can see that initially we were in this really clear range bound scenario. The price was oscillating between this low point and this high point here. You can see that the Bollinger Bands are turned roughly flat, indicating a lack of direction and volatility in the market. However, at this point here, once price breaks down below that big low at the 132.90 level, price starts to trend lower, and you can see the Bollinger Bands themselves turn lower, indicating bearish direction in the market. And so once we can identify price pushing along these lower Bollinger Bands, we're only looking to sell, okay? So we're no longer looking to buy. We're not interested in trading the lower Bollinger Band. We're waiting only for periods of correction that take price back up into a retest of the upper Bollinger Band. So remember, the information that the Bollinger Bands give us relating to volatility momentum tell us that once price has traded to the upper Bollinger Band, volatility is overstretched and a reversal is likely. So once we've identified a bearish trend, we're looking for periods of exhausted bullish momentum, exhausted volatility, where we can then trade a resumption of the trend. And there are two really great examples here. You can see, first of all, after the initial breakdown in the euro, we traded back up. We simply tested that upper Bollinger Band very slightly before price turned lower. We broke down from that point. We entered another period of consolidation here where price was caught in a range. We traded back up, retested the upper Bollinger Band, and again we got a fantastic sell entry before that really steep decline into the start of 2015. So again, a really fantastic way of helping us to gain entry to trending markets and helping us to stay on the right side of the momentum in the market. So the final method then that I want to look at is actually how we can use the information that Bollinger Bands are giving us about volatility. So we've identified that a contraction in the Bollinger Bands is demonstrating low volatility in the market, and that an increase, an expansion in the Bollinger Bands is demonstrating increased volatility. So we can actually use these two dynamics to create trading opportunities. So the market moves in cycles of expansion and contraction, trend and range, breakout and correction, and the Bollinger Bands give us a neat visual cue as to when this is happening and to what state the market is in, such that we're then able to form trading ideas based upon what the Bollinger Bands are telling us about the market. So in this slide, look at the information that the Bollinger Bands are giving us about the market. So firstly, to the top, you can see that we have price trading around. The Bollinger Bands are turned roughly flat here, okay, indicating a lack of direction. We're contracted at this point. We're contracted at this point, indicating a lack of volatility in the market. So this all lines up with being in a range-bound scenario, okay, where there is a lack of direction in the market, but also a lack of momentum and volatility. However, at this point here, once price breaks down below that big low, okay, so if we identify this as being the key support low in this period of price action, then once price has broken down below that low and starts to trend lower, look how the Bollinger Bands indicate the evolution of price action. So you can see we first of all turn sharply lower, indicating the presence of a bearish trend. You can then see that the Bollinger Bands have also widened, showing us that there's increased volatility in the market. Just a quick question there asking what are the period values for the standard deviations. So the standard deviations are set to +2 and -2, so they'll come as a default on your MT4 terminal. So the look back period is a default 20 period, and the standard deviations are 2 standard deviations above the average and 2 standard deviations below. So going back to what the indicator is telling us about the state of the market. So we've moved out of a clear range-bound scenario here. The Bollinger Bands have turned lower. We've moved into a clear bearish trend phase here. And then look what happens. We get this really interesting formation where after that initial expansion and downside surge in the market, the Bollinger Bands turn flat. Okay, the Bollinger Bands start to contract. That shows us that both direction and volatility have leaked from the market, and we enter this range-bound period where price is simply grinding higher and lower but not making any clear directional move. Okay, so look at the Bollinger Bands over this period turned sharply lower, very wide, compared to this period here where they're flat and much narrower. So this is showing us clearly the difference between trend and range in the market. We then get another period of trend resumption here when the market expands to the downside, and again those Bollinger Bands turn lower and they widen, showing us that both direction and volatility have returned to the market before once again we move back into a range-bound scenario here where the volatility bands contract and also the Bollinger Bands flatten out. So what we've got here is another period of consolidation in the trend before finally we get a final trend expansion. Okay, so you can see pardon me, so you can see that this forms almost a staircase visual. Okay, so we go down, along, down. So this is a textbook trend formation, and the Bollinger Bands are highlighting this for us. And so all we're really looking to do in these scenarios is identify these periods of consolidation within a trend where we can then look to play a breakout as a continuation of the trend. So for example here where we've identified a clear bearish trend, we then look to identify a period of consolidation, so a small range-bound period, before simply looking to sell short as price breaks below the low of that consolidation in line with what the Bollinger Bands are telling us. So we can always use the Bollinger Bands to confirm if we're feeling unsure about the moves that we're seeing in price. So as price breaks down and we see the Bollinger Bands turning lower, indicating a bearish trend, and we see the volatility bands widening, showing an increase in volatility, then this confirms to us that our bias is correct. And once again here you can see price trades down into this low, we get another low, so we've got our clear support lows here. All we're waiting to do in this scenario is for price to break below those lows, and then we're looking to short. So we're simply using the Bollinger Bands to confirm our assessment of the trend. So for those of you who are familiar with identifying trend structure, this shouldn't be too hard for you. And then for the beginners, okay, we've got webinars and we've got information on the website about identifying different market structure such as trend and range. So all we're looking to do is identify these periods of expansion in the market, followed by these periods of consolidation, and then we're simply looking to enter. And as I say, the Bollinger Bands are simply a great way of helping us identify clearly these periods in the market, because I know, especially for a lot of new traders, that sometimes it can be difficult when you pull up a chart to decisively confirm which state the market is in, whether it's trending or ranging. And so to help you get good at doing that, before you get good at doing it simply visually, just doing it on a naked basis without any indicators, then the Bollinger Bands are a fantastic way of helping you get to that point. Okay, so we've covered a lot of material in this session, and I hope that you've, sorry, that was a slide from a previous webinar, which has creeped in there. But yeah, I hope you've enjoyed this session and found it really useful and that you're looking forward to testing this stuff out for yourself. As I say, there are so many different combinations of moving averages and settings and time frames that you can work on, and the same with the Bollinger Bands, that you can really get lost for days exploring this stuff. And to be honest, that's what I suggest you do. You know, really spend some time looking through the charts, testing out the different settings, the different combinations of moving averages for the crossovers, looking at the Bollinger Bands, remembering that neat trick that I've showed you, how you can get higher time frame indicators on the lower time frames, and spend some time looking at the types of different signals and thinking about the way that you could trade these indicators. So that's it from me today. Before I go, are there any questions that I can answer for anyone? Thanks a lot. Thanks for your comment and feedbacks, and for everyone that's joined in today. It's been a really good session. I'm pleased that you've got a lot out of it. Great, thanks a lot. Okay, well look, the recording will be available very soon, and you can also get the slides for the session. I'll make those available too. And I'll catch up with you all next time. Thanks a lot, everyone.